Okay, so we all know Disney, and a lot of people feel quite nostalgic about this company because they grew up with it as a child. And rightly so, they have been around for a long time and they continue to impress us with really good content. But times are changing, and for Disney, should we invest a large portion of our portfolio into this company, and is it even still a solid company at all? Now, if you're new to my channel, well, welcome, and my videos are about investments that anyone in the world can make. And I think the stock market is one of the best places to invest. But the harsh reality is that about 90% of all people who trade on the stock market, they fail. And every year there are new people that think that the stock market is their place to make all of this money and all their riches for the rest of their life, but unfortunately it doesn't work like that. So if you are new, well, the odds are unfortunately stacked very heavily against you. So my channel is all about trying to help as many people as possible not be in that 90%. And the first thing we have to do is we have to really understand what it is we're actually investing in. All right, now let's take a good look at Disney. Now, if you haven't read the book One Up on Wall Street by Peter Lynch, well, firstly, I highly recommend going and doing that. And then secondly, once you've done that, you'll know that every company falls into one of these 6 categories. So a company could be a slow grower. So that's a large, mature, they're growing at about 5% or less, and that's the expected long-term growth rate. Then you've got stalwarts, which they're large, they're mature, but their growth rate is better than the slow growers. Then you have the fast growers, and these are small companies, but they have very high expected growth rates. These are the exciting companies that a lot of people talk about. Cyclicals, well, they move up and down depending on what part of the cycle they are in. Then we have asset plays. Now this is when the assets are worth far more than the stock price. And the last category is a turnaround, and these are heavily discounted and they're probably in dire straits. Something's wrong with this company, but maybe they can turn it around. And for each of these, we actually approach the investment in a slightly different way. And what we have to do is try to categorize the company that we're looking at into one of these or maybe multiple of these areas. So what we want is to identify which of these categories Disney fits into. Now, funnily enough, Disney actually over its entire lifetime has actually been in all 6 of these categories before. But right now, I think it is a slow grower because its expected growth rate over the next 5 years is around about 2%. And because now it's such a large company, well, it's always going to be either a slow grower or a stalwart because can't fit into the other categories anymore. Now, generally a slow grower isn't exciting. And what we're really looking for to invest in a slow grower is we want a really good discount on the intrinsic value. Because obviously we don't want to get 2% per annum for the next 5 years. That's not a really good investment. So we need that big discount. Now, this 2% growth rate is actually what the analysts think, not actually what's going to happen. So we can come up with our own thesis of what we think might happen, and therefore we might have some sort of edge over the competition, well, the other investors. So to see if we have a different opinion to what the analysts are thinking, well, we need to look at the competitive advantage and the future for Disney. So Disney, I think, has one of the best competitive advantages that I can think of. The film division formula has been working beautifully for Disney over the years with their Star Wars, Marvel, and Pixar franchises. Then it's their ability to monetize these franchises after the movie has come off the big screen that is truly remarkable. Just think about how much Star Wars and Avengers merchandise gets sold every year. And these are just 2 of the brands they have. They have actually hundreds of different brands, which is really the beauty of Disney. They have the ability to create a new movie, and if it's a hit, then they get thousands of licensing deals, added boosts to their theme parks, more Disney Plus subscribers, more merchandise sales, and then sequels on top of that. As business models go, this is one of the best out there. So Disney has been hit really hard because of the lockdown. Think their cruise lines, their theme parks, and the movies. So obviously it's going to be a really tough year or 2 until the world starts to forget about the virus and we can actually move on. But it could take quite a long time. But on the positive side, we can turn our attention to the new streaming service, Disney Plus. Now, Disney Plus, well, this sounds ideal for the lockdown as all the parents are at home trying to think of ways to entertain their kids. Oh, that must be difficult. Kids stuck at home all day, every day, that must be a nightmare. So if I had kids at home and they were screaming and terrorizing the house, well, I'd want to get something to entertain them as well. So Disney Plus sounds perfect. Now, I'm not alone here, as Disney has just reported that they hit 60 million subscribers to their Disney Plus service. Now, just to put that into context, this was what Disney were hoping to reach by 2024. So it's arrived 4 years earlier. So it has been a huge hit. So prior to the lockdown, analysts were expecting Disney to be growing at around about 2% per annum, and I actually think prior to the lockdown they were wrong. But because of the lockdown and the theme parks and the movies and all that stuff being stopped, well, I actually think 2% now sounds about right. But eventually, I'm very confident that with Disney Plus, the new Marvel movies, new Star Wars movies, and new franchises that haven't even started yet, well, this will drive far larger long-term growth. But before you go out and invest, this is only half the story, and this is where a lot of people get burnt on the stock market. So many people get sold on the story of the company, but they don't actually take the time to look at what they're buying. And as Benjamin Graham pointed out like 60 years ago, the market eventually goes back to its intrinsic value. So the question still remains, is Disney a financially strong company, and are they at a bargain price? Now, there are three key areas to the health of any business. We want to see whether they can handle their debt, whether they're growing, and whether they're a well-managed company. But just sit back and relax and don't worry about the terminology, just get a feel for what's going on. But before you sit back and relax, if you wouldn't mind hitting the like button for me, it helps me grow and encourages me to make more videos. So it's really important to look at the company's debt, because if the business was to completely stop for some unforeseen reason, let's say another virus came along, well, we want to make sure that they're going to survive it. And with low debt, well, they have low repayments, which means they can last a lot longer. So to see if the business can handle its debt, I go through the debt to equity ratio and the current ratio of the business. And for Disney, the debt to equity has actually jumped up. Now I'm looking for it to be below a 0.7. And at 0.7, it's okay, but it's something to watch. This is the current ratio, and I'm looking for it to be above a 1.5 normally. And Disney, well, it hasn't been there for a while now. So this doesn't put them in a short-term strong position. See, Disney can definitely handle its debt because it has so many assets. I just don't want to see the debt growing. To check for growth in the finances, I look at the book value per share, earnings per share, and operating cash. So pretty obvious what has happened here. Things were trending nicely until the last 12 months. I think it is important to note that the earnings per share was weaker before the crisis. So are they growing? Well, no, they're not at all. And I do think over the medium term, they will get back to breaking their records again, but in the short term, no. Now, it'd be pretty cool to sit with the Disney management team and hear about all the things that they're planning and see whether they're making some good decisions. But we can't do that. So there are some telltale signs in the financials that will give us the hint whether they're making some good decisions or not. So I'm going to check for the return on equity, the free cash flow, cash on hand, and whether they're paying a dividend. Now, I want to see the return on equity above a 15, as it shows management are improving the value for the shareholders. So Disney hasn't been above even 10 in the past. So this is not a great investment. Now, the cash at the bank has jumped a lot, and this is for two reasons. Disney actually suspended paying their dividend and added some more debt. Not a bad idea in this situation, as they want to make sure they can weather this storm. But that weak return on equity is not something I want to see. So unfortunately for Disney, they're in a really tough spot right now, and I do think they're going to get out of it, but if we're going to invest, well, we want to invest at a really good price. The reason I want this really good price is because it's going to take them some time to get back on their feet, and we don't know what might happen in the future either. So let's go take a look at their intrinsic value. Now, here are all the metrics on the screen that I use to find intrinsic value. And to get a copy of the calculator that will help you find intrinsic value, I have a link in the description, and it's free if you want it. Now, after entering these numbers into my intrinsic value calculator, I came up with the current intrinsic value of $44. Now, that's with no margin of safety because I've used a discount rate of 8.5. Now, what I've done for a little bit of fun here is I've tried to calculate the intrinsic value prior to the crisis. And I use these metrics here on the screen. And in 2018, the intrinsic value would have been $138. Now again, with no margin of safety. Now right now, it's early September and the current share price is about $130. So what does all this mean? Well, it means that the current share price, well, it's valuing the company pre-crisis and with no margin of safety. So it's like we've completely removed this entire lockdown situations affecting Disney's stock price, and that's what you're paying for right now, pre-crisis levels. But we can't just ignore the pandemic. It had a huge impact on the business and it could take a long time to recover. So it would be crazy to invest at these prices, and in my opinion, there is really no upside here. So do I think currently Disney is a good investment? Now, I'm not the only one who thinks this is overvalued. This website is from Simply Wall Street, and they use a different method to calculate value that I don't completely agree with, but they think it is even more overvalued than me. So we are really not even in the ballpark regarding a reasonable price. The Disney story is really solid, and I really actually like the company, but they're nowhere near investable at the moment. And I'd really love to hear your thoughts on this investment because I know a lot of people out there have requested videos about Disney and they think it's a great investment. And hit subscribe if you enjoyed this analysis, and I will see you in the next video.